There is a silent killer stalking the stock market. It's an invisible toxin that can take a wonderful, growing, celebrated business and turn it into a smoldering crater of bankruptcy, seemingly overnight. It's a force so seductive that it has lured the most brilliant minds in finance to their ruin, and so common that it's hiding in plain sight within the portfolios of millions of retail investors. During the good times, when the sun is shining and the economy is humming, it masquerades as a brilliant strategic tool. It's called leverage, it's called debt. And for decades, the single greatest investor of all time, Warren Buffett, has waged a quiet war against it. He hasn't just avoided it. He has built his entire philosophy, his entire nine-figure fortune, around a principle so simple yet so profound, it has become his final promise to himself and his shareholders. A great business, a business worthy of your life's savings, should not need a lot of debt. This isn't just a casual preference, it is the central girder in the entire framework of his success. It is the master principle that allows for wealth preservation through the darkest of economic storms. It's the reason he sleeps soundly at night while other CEOs and investors are staring at the ceiling, terrified of a phone call from their banker. And understanding this principle, truly internalizing it to the point where it becomes an automatic reflex in your own stock picking, is the most significant step you can take to move from a market speculator to a true business owner. It is the financial transformation that will allow you to build a portfolio that doesn't just grow, but endures. Today, we are going to deconstruct this master principle. We will explore not just what Buffett does, but why he does it, delving into the powerful psychological forces that make debt so tempting and so deadly. We will translate his philosophy into a practical toolkit, a step-by-step process of due diligence that any investor, from a beginner navigating the stock market for the first time to a seasoned professional, can use to spot the ticking time bombs in their own portfolio. This is more than just financial education, it is a lesson in survival. Our journey begins with the most seductive illusion in all of finance, the illusion of amplification, and why this powerful force both seduces and ultimately destroys those who fall under its spell. To understand its power, we must travel back to the late 1990s, a time of technological euphoria and intellectual arrogance, a time when a small group of the world's smartest people thought they had solved the problem of risk forever. Their story is a chilling, cautionary tale. In the quiet, manicured town of Greenwich, Connecticut, a hedge fund was operating unlike any the world had ever seen. It was called Long-Term Capital Management, or LTCM. And on its board sat financial royalty, Myron Scholes and Robert C. Merton, two men who had just won the Nobel Prize in Economics for their work on options pricing. Alongside them was John Meriwether, the legendary former head of bond trading at Salomon Brothers, a man considered a god in the world of arbitrage. These were not reckless gamblers, they were the high priests of financial mathematics. They had built complex computer models that they believed could identify tiny, fleeting mispricings in the global bond market. Their strategy was to make thousands of these tiny bets, each with a very high probability of a small profit. The profits on any single trade were minuscule, almost pathetic. But they had a secret weapon to turn these pennies into a fortune: leverage. Astronomical, breathtaking amounts of leverage. For every $1 of their own capital, they borrowed over $25. Think about that. Their balance sheet showed over $100 billion in assets, but it was supported by a sliver of their own money. It was a skyscraper of financial obligations built on a foundation of sand. And for a while, the strategy worked with jaw-dropping perfection. From 1994 to early 1998, they generated annualized returns of over 40%. They were the envy of Wall Street. Their success seemed to prove a new paradigm, that with enough brainpower, risk could be mathematically modeled and tamed. They were so confident in their models that they told investors their system was as safe as a money market account, but with the returns of a high-growth stock. They believed they had built the perfect money machine. But in August of 1998, the machine began to sputter. Russia, a country they had significant exposure to, defaulted on its government bonds. It was an event their models had predicted would happen only once in thousands of years. It was a statistical impossibility, and yet it was happening. Suddenly, markets around the world seized up. The tiny mispricings they were betting on didn't converge as their models predicted. They diverged wildly. The small, safe bets they had made started generating catastrophic losses, and because of their massive leverage, those losses were amplified 25-1. Every dollar they lost was a $25 hole blown in their balance sheet. Within a few weeks, this fund, run by Nobel laureates, the supposed masters of risk management, had lost over $4.5 billion. They were on the brink of total collapse. The problem was, LTCM was so large and so interconnected with every major bank on Wall Street that its failure threatened to trigger a domino effect, a complete meltdown of the global financial system. The Federal Reserve of New York had to intervene, orchestrating an unprecedented emergency bailout. They gathered the heads of every major bank into a single room and told them they had to pony up over $3.5 billion to save LTCM, and by extension, themselves. And in the middle of this chaos, who received a phone call? Warren Buffett. He was part of a consortium with Goldman Sachs and AIG that put in a bid to buy out LTCM's entire portfolio for a mere $250 million, a fraction of its former value, and inject a few billion in fresh capital. Their bid was ultimately rejected in favor of the banker-led bailout, but Buffett's involvement gave him a front-row seat to the single greatest example of leverage-induced destruction in modern history. He saw firsthand how the smartest people in the world, blinded by their own brilliance and the seductive power of borrowed money, had brought the entire world to the edge of an abyss. The lesson was burned into his mind. Intelligence is not a defense against the ravages of leverage. In fact, it can make it worse. The story of long-term capital management is so powerful because it perfectly exposes the underlying psychological principles that make debt so dangerous. The partners at LTCM were not fools. They were victims of two of the most potent cognitive biases that afflict human decision-making: the overconfidence bias and recency bias. Overconfidence bias is the deeply ingrained tendency for people to believe they are smarter and more capable than they actually are. The Nobel laureates at LTCM were the embodiment of this. They had prestigious awards, they had created the very financial models the world used, and they were surrounded by people who told them they were geniuses. This created an intellectual echo chamber where their belief in their own infallibility became absolute. They believed their models were a true representation of reality, not just a simplified map of it. They couldn't imagine a scenario where their assumptions were wrong, so they felt perfectly comfortable applying massive amounts of leverage. They thought they had eliminated risk, when in reality, they had simply concentrated it to a single, fatal point of failure. This is a trap that ensnares not just Nobel laureates, but business executives and retail investors alike. When a CEO sees their company's stock price soaring because they took on debt to buy a competitor, they start to believe they are a brilliant dealmaker. When an investor sees their portfolio double because they bought high-leverage growth stocks in a bull market, they start to believe they are an investing prodigy. Overconfidence clouds judgment and makes the addition of more and more debt seem not just acceptable, but prudent, a sign of genius. The second bias, recency bias, is the human tendency to give greater importance to recent events than to historical ones. We project the immediate past into the indefinite future. For 4 years, LTCM's strategy had worked flawlessly. Every single month, the data confirmed their thesis. The positive reinforcement was constant. This recent string of successes made the possibility of a catastrophic failure feel distant and theoretical. The world of August 1998, the world of the Russian default, was simply unimaginable to them in July 1998. In the same way, investors who have only experienced a bull market, where credit is cheap and asset prices only go up, develop a dangerous complacency. They see companies taking on more debt and see it work. They see leveraged real estate developers making fortunes. They see private equity firms using debt to buy companies and flip them for a profit. The recent data all points to one conclusion. Debt is a tool for creating wealth. They forget the lessons of 1929, of 1987, of 2000, of 2008. They forget that the credit cycle always, eventually, turns. The tide goes out, and as Buffett famously says, you discover who's been swimming naked. Recency bias creates a blind spot to what is known as tail risk, the low-probability, high-impact events that can cause total ruin. Debt doesn't create tail risk, but it acts as a massive amplifier for it. A business with no debt might have a terrible year during a recession. A business with high debt ceases to exist. So how do we, as individual investors, systematically override these powerful psychological biases? We need an applied mental model, a blueprint that forces us to see the world through a different lens. Buffett's approach can be distilled into applying his most famous concept, the margin of safety, directly to a company's balance sheet. The common application of margin of safety is about price. You estimate a company's intrinsic value and then insist on buying it at a significant discount. But the more profound application is about the business itself. The ultimate margin of safety is not buying a fair business at a wonderful price, but buying a wonderful business that is so structurally sound, so financially robust, that it can withstand the shocks and surprises the world will inevitably throw at it. The blueprint is to invert the typical investor's line of questioning. The average person looks at a company and asks, how much can this business grow if it uses debt? This question focuses entirely on the upside. The Buffett-inspired model inverts this and asks, what is the plausible worst-case scenario that could make this company's current debt load fatal? This forces you into a mode of thinking that prioritizes survival above all else. This mental model can be put into practice through a process of rigorous stress testing. First, you look at the company's income statement and identify its core profitability, its earnings before interest and taxes, or EBIT. This is the raw engine of the business. Then, you look at its balance sheet and identify its total debt and the associated interest expense. The first stress test is an economic downturn simulation. You ask, what would happen to this company's EBIT if a severe recession hits and its revenue drops by 30%? For a software company, maybe EBIT falls by 30%. For an airline or a restaurant, it might fall by 80%, or even turn negative. Then you look at the interest expense. That number doesn't change. It's a fixed, non-negotiable claim on the company's earnings. Can the new lower EBIT comfortably cover the interest expense? If the answer is no, you have found a fragile business. The second stress test is an interest rate shock. You ask, what if the company has to refinance its debt in a world where interest rates have doubled? Many companies have debt that needs to be rolled over every few years. If their interest expense suddenly doubles, what does that do to their net income? Does it wipe it out completely? This simple two-part stress test, a revenue shock and an interest rate shock, is a powerful antidote to the optimism of overconfidence and recency bias. It forces you to confront the brutal realities of leverage. It shifts your focus from dreaming about the potential returns to soberly assessing the probability of ruin. A business that can easily survive both of these stress tests is a business that has a true margin of safety built into its very financial structure. This disciplined, survival-focused approach is the polar opposite of the path followed by the 99% of market participants. The antithesis of Buffett's philosophy is the widespread addiction to leveraged growth stocks. This is the path of chasing narrative and momentum, often without a single glance at the underlying financial statements. The typical retail investor is drawn to stories of rapid expansion and market disruption. They hear about a company that is opening hundreds of new stores, or acquiring its competitors, or spending billions on research and development. The stock price is soaring, and the media is celebrating the visionary CEO. This creates a powerful fear of missing out. The investor sees the rising stock chart and equates that momentum with business quality. They are completely captivated by the story of growth, but they fail to ask the most important question: how is this growth being financed? In many cases, the answer is a mountain of debt. Think of the shale oil boom in the 2010s. Companies were borrowing billions of dollars to drill new wells, promising incredible production growth. Their stock prices went parabolic. Investors who piled in were betting on a story of American energy independence. But they ignored the balance sheets. These companies were incredibly fragile, entirely dependent on high oil prices to be able to service their massive debt loads. When oil prices collapsed in 2014 and again in 2020, hundreds of these companies went bankrupt. The story was great, but the financial foundation was rotten. This is the path of the 99%, falling in love with a company's income statement, its growth story, while remaining completely ignorant of its balance sheet, which tells the story of its solvency and survival. They are chasing returns without ever calculating the risk, a strategy that works brilliantly until the day it leads to a total wipeout. The direct financial connection, the specific mechanism by which debt creates this illusion of success, is the manipulation of a single, widely followed metric, return on equity, or ROE. This metric is supposed to measure how efficiently a company is using its shareholders' capital to generate profits. On the surface, a high ROE looks like a sign of a wonderful business, but debt allows companies to play a financial magic trick that can make a mediocre business look like a superstar. Let's imagine two companies, Company A and Company B. Both are in the same industry, and both have $100 in assets. Company A is the fortress. It's financed entirely with $100 of shareholder equity and has zero debt. Let's say it generates $10 in profit. Its return on equity is $10 of profit divided by $100 of equity, which is 10%, a solid, respectable return. Now let's look at Company B, the leveraged operator. It also has $100 in assets, but it's financed with only $10 of shareholder equity and $90 of debt, which it borrowed at a 5% interest rate. Company B's business is identical to Company A's, so it also generates $10 in profit before times interest payments, but it has to pay interest on its $90 of debt. 5% of $90 is $4.50. So its net profit after interest is $10 minus $4.50, which equals $5.50. Now, what is its return on equity? It's $5.50 of profit divided by only $10 of equity. That's a staggering 55% ROE. A naive investor screening for high ROE stocks would immediately be drawn to Company B. It looks like a phenomenal business, 6 times more efficient than Company A. But it's an illusion. The underlying business is identical. The only difference is the capital structure. Company B has simply used a debt to amplify its returns on a very small sliver of equity. This is the financial engine of the private equity industry. They buy companies, load them up with debt to reduce the equity portion, and then sell them, pointing to the sky-high ROE as proof of their operational genius. But what this metric hides is the astronomical risk. In our example, if a recession hits and profits for both companies fall from $10 to just $5, Company A is fine. Its ROE drops to 5%, but it's still profitable and completely stable. What about Company B? Its profit before interest is now $5, but it still owes $4.50 in interest. Its net profit is now only 50 cents. Its ROE has collapsed from 55% to just 5%. If the profit falls to $4, it breaks even. If profits fall to $3, it is now losing money, and its equity is being eroded. Company B is a tightrope walker with no safety net. Company A is walking on solid ground. This is the direct financial connection. Debt is a tool used to artificially inflate return on equity, fooling investors into believing a business is safer and more profitable than it truly is. Learning to look past the headline ROE and dissect the balance sheet is the first crucial step in your due diligence to protect your portfolio. Having witnessed the destructive power of leverage, we must now turn our attention to its opposite, the ideal state that Buffett constantly seeks. This is the concept of the fortress balance sheet, a blueprint for what he considers corporate immortality. This isn't just about avoiding bankruptcy. It's about creating a business so financially powerful, so self-sufficient, that it becomes a platform for generating extraordinary, multi-generational wealth. The perfect story to illustrate this principle is not one of a crisis averted, but of a quiet, methodical, cash-generating machine that became the very model for the Berkshire Hathaway empire. The year was 1972, and Warren Buffett and his partner Charlie Munger made a deal to buy a small, family-owned candy company based in California for $25 million. The company was See's Candies. On the surface, it might have seemed like an odd purchase for a sophisticated investor. It was a simple, old-fashioned business. But Buffett saw something profound in its financial structure. See's was a business of remarkable quality. It had a beloved brand, a loyal customer base, and pricing power. It could raise its prices year after year without losing customers. But the true magic was on its balance sheet and in its cash flow. See's required almost no capital to grow. Think about how the business worked. Customers would pay for their Christmas chocolates in December, but See's wouldn't have to pay its suppliers for the sugar and chocolate until January or February. This created what's called float. The company was holding its customers' money before it had to pay its own bills, which is like getting a perpetual, interest-free loan. Furthermore, to open a new store, See's didn't need to build a massive factory or invest in heavy machinery. It needed a lease, some display cases, and some inventory. The capital requirements were minuscule. As a result, the business gushed cash. It was a fountain of money. In their first year of ownership, See's generated $2 million in pre-tax profit. By the time Buffett wrote his 2007 shareholder letter, See's had generated over $1.3 billion in pre-tax profit for Berkshire, and it had required only $32 million in additional capital investment over those 35 years. It was almost entirely self-funding. It never had to call a banker. It never had to issue new stock. It was a perfect, closed-loop system that took in customer cash and produced ever-growing profits. Profits which then flowed up to Berkshire's headquarters in Omaha to be deployed into other investments. See's Candies became Buffett's prototype for the ideal business. It wasn't just debt-free, it was anti-debt. It produced so much cash that the challenge wasn't how to finance its operations, but what to do with all the excess money. This is the fortress balance sheet in its purest form. A business whose own internal operations generate far more cash than the business can intelligently reinvest, creating a river of deployable capital for its owners. The psychological principle that underpins the desire for a fortress-like business is more subtle than the fear of ruin. It's a combination of the endowment effect and a powerful preference for the status quo. The endowment effect is our tendency to value something more highly simply because we own it. When you buy a stock, it's no longer just a ticker symbol, it's asterisk your company. If that company is a fortress like See's Candies, you don't just see it as a good investment, you become psychologically attached to its stability and its permanence. You start to value its resilience as much as, if not more than, its potential for growth. This is why Buffett talks about owning stocks he would be happy to hold if the stock market closed for 10 years. He is not just thinking like an investor, he's thinking like an owner who has endowed the business with a sense of personal value and a desire for its perpetual existence. This leads to a strong preference for the status quo. When a business is stable, profitable, and requires no external financing, its future feels predictable and secure. The owner is not forced into making high-stakes decisions. They don't have to worry about refinancing debt in a panic. They don't have to consider selling off valuable assets to appease creditors. This state of financial tranquility is incredibly valuable. It allows for clear, rational, long-term decision-making. The absence of financial pressure is a strategic advantage. Buffett's famous quote, "We would rather have a lumpy 15% return than a smooth 12%, is often misinterpreted. He's willing to accept volatility in the stock price, but not in the underlying business. The fortress balance sheet ensures the business itself is smooth and predictable, even if the market's perception of it is lumpy. It's a strategy designed to maximize peace of mind, which he understands is a prerequisite for making intelligent capital allocation decisions over a lifetime. To translate this ideal into a practical blueprint for investors, we can use Buffett's own concept of owner earnings. This is his method for calculating the true cash-generating power of a business. It's a mental model that cuts through the often misleading numbers of reported net income. The formula is simple. Owner earnings equals net income, plus non-cash charges like depreciation and amortization, minus the average annual amount of capital expenditures the business needs to spend to maintain its competitive position and unit volume. Essentially, it's the cash that is truly available to the owners to do with as they please, either reinvest for growth or take out of the business. The blueprint for finding a fortress balance sheet is a three-step process using this owner earnings concept. Step 1. Calculate a conservative estimate of the company's owner earnings for the past 5 to 10 years. You want to see a consistent and growing stream of cash. This isn't a one-year snapshot. It's an analysis of the business's long-term earning power. Step 2. Go to the balance sheet and find the company's total debt, both long-term and short-term. Step 3. Compare the two numbers and ask the crucial question: could this business pay off every single dollar of its debt with between 1 and 3 years of its true owner earnings? If the answer is a resounding yes, you have likely found a financial fortress. A company that can extinguish all its obligations with just a few years of its own cash flow is a company that is in complete control of its own destiny. It is not beholden to bankers, bondholders, or the whims of the credit markets. This debt paydown test is a simple but incredibly powerful filter. It quickly separates the self-sufficient cash machines from the companies that are dependent on the kindness of financial strangers to survive and grow. This search for self-sufficiency is the complete antithesis of the growth-at-any-cost mentality that dominates so much of the modern business world. This is the path of the 99%, and it is paved with borrowed money. This mindset is most prevalent in the worlds of venture capital and private equity, and it often infects the management of public companies who feel pressured to compete. The primary goal is not profitability or stability, but scale. The mandate is to grow revenue, capture market share, and increase the company's valuation as quickly as possible. In this paradigm, debt is not a danger, it's rocket fuel. Companies are encouraged to burn through cash, to lose hundreds of millions or even billions of dollars a year in pursuit of market dominance. The balance sheet is an afterthought. The only thing that matters is the growth narrative. A perfect example of this was WeWork. The company had a compelling story to revolutionize office space for the modern workforce. It was growing at a blistering pace, opening new locations around the world. But this growth was fueled by tens of billions of dollars in borrowed money and equity investments. The company was hemorrhaging cash. Its own financial statements revealed that it had long-term lease obligations, a form of debt, that were many times its annual revenue. It was a business model that was structurally and permanently unprofitable, with a balance sheet stretched to the breaking point. Yet, investors, caught up in the story of disruption and the charisma of its founder, valued it at nearly $50 billion. When the company tried to go public and was forced to reveal the true horror of its financial condition, the entire house of cards collapsed. The valuation plummeted by over 90%, leading to massive losses for its investors and backers. This is the inevitable outcome of the growth-at-any-cost philosophy. It prioritizes a seductive story over sound financial footing, creating businesses that are magnificent in their ambition but incredibly fragile in their construction. The 99% are drawn to these stories like moths to a flame, ignoring the clear red flags on the balance sheet, only to get burned when the cash runs out. The direct financial connection for a fortress balance sheet, the specific numbers you can look at to quantify its strength, comes down to two simple but powerful ratios: the interest coverage ratio and the debt-to-equity ratio. These are the vital signs of a company's financial health. The debt-to-equity ratio is a straightforward measure of a company's leverage. You find the total liabilities on the balance sheet and divide it by the shareholders' equity. A number below 1.0 is generally considered conservative, suggesting the company is financed more by its owners than by its creditors. A number above 2.0 suggests a significant reliance on debt and should be a cause for further investigation. While this ratio is useful, it's a static snapshot. It doesn't tell you about the company's ability to handle that debt. That's where the interest coverage ratio comes in, and it is arguably the more important of the two. This ratio measures how many times a company's operating profit can cover its required interest payments. You calculate it by taking the earnings before interest and taxes (EBIT) from the income statement and dividing it by the interest expense. A fortress-like company, say a mature technology giant like Apple or a consumer staple powerhouse, might have an interest coverage ratio of 20x, 50x, or even 100x. Their earnings are so massive relative to their interest payments that the debt poses virtually no threat. In contrast, a highly leveraged company, like an airline or a major utility, might have an interest coverage ratio of just 3x or 4x. This is a razor-thin margin of safety. A small dip in their business, due to a recession, a spike in fuel prices, or new competition, could cause their EBIT to fall to a level where it can no longer cover the interest payments. That is the technical definition of insolvency. When you perform your stock analysis, looking at these two ratios together gives you a clear picture. A low debt-to-equity ratio combined with a very high interest coverage ratio is the quantitative signature of a fortress balance sheet. It's the hard data that proves a company is not just telling a good story, but has built a financial structure capable of surviving for decades to come, a key component of any strategy focused on long-term investing and wealth preservation. This brings us to one of the most crucial concepts in understanding Buffett's aversion to debt, the brutal mathematics of risk. It's the idea of asymmetry, the unseen and often unappreciated cost of a single bad year. In a world without leverage, the risk and reward are somewhat symmetrical. If a business has a good year, you make money. If it has a bad year, you lose some money. But the business survives to fight another day. Debt completely shatters this symmetry. It creates a situation of capped upside and unlimited, catastrophic downside. With debt, if a company has a decade of good years, the shareholders do well, but a significant portion of the profits goes to servicing the debt. The upside is shared with the creditors. However, if the company has just one single terrible year, it can breach its debt agreements and be forced into bankruptcy, wiping out 100% of the shareholders' investment. A decade of prudent gains can be vaporized in a matter of months. This is the devil's bargain of leverage. You trade a portion of your upside in the good times for the risk of total annihilation in the bad times. To truly understand how deeply Buffett feels this, we must look at what he considers his greatest investment mistake, not because it lost the most money, but because it so clearly illustrated this principle. In 1993, Warren Buffett bought the Dexter Shoe Company. At the time, it looked like a classic Buffett investment. It was a well-known, American-made brand. It was profitable. It had a strong position in its market. Buffett was so confident in the business that he didn't pay cash for it. He paid with Berkshire Hathaway stock, valued at the time at $433 million. This would prove to be a colossal error. Shortly after the acquisition, the durable competitive advantage that Buffett thought Dexter possessed began to evaporate. Low-cost shoe manufacturers from overseas flooded the market, and Dexter, with its American-based manufacturing, simply couldn't compete on price. Its profitability collapsed, and eventually the business became worthless. Buffett had made a fundamental mistake in judging the long-term economics of the business. Now here is the crucial point. Because Dexter was purchased by Berkshire Hathaway, a company with a pristine, fortress balance sheet, the failure was not fatal. Dexter Shoe simply became a failed division within a thriving conglomerate. It was absorbed. It was a painful mistake, an expensive lesson, but it didn't threaten the survival of the parent company. But now imagine an alternate reality. Imagine if Dexter Shoe had been a standalone company, and in an effort to modernize its factories or expand its distribution in the early 90s, it had taken on a large amount of debt. When the cheap foreign competition arrived and its profits evaporated, it would not have been able to make its interest payments. It would have breached its covenants. The bankers would have taken control, and the company would have been liquidated. The shareholders would have been left with absolutely nothing. Buffett's mistake would have been transformed from a costly error into a total catastrophe. The Dexter Shoe story is his permanent, personal reminder that even the greatest investor in the world cannot predict the future of every business with perfect accuracy. Mistakes are inevitable, and since you cannot eliminate business risk, you must do everything in your power to eliminate financial risk. Debt is the explosive charge that turns a manageable business mistake into a corporate detonation. The psychological force that makes this asymmetry so terrifying is one of the most well-documented biases in behavioral economics: loss aversion. Pioneering research by psychologists Daniel Kahneman and Amos Tversky showed that for most people, the pain of losing a dollar is psychologically about twice as powerful as the pleasure of gaining a dollar. We are hardwired to feel losses much more acutely than gains. This has profound implications for investing. A strategy that generates steady, moderate gains will often feel psychologically superior to a strategy that produces higher average gains but includes the possibility of a large, sudden loss. Buffett's obsession with avoiding debt is a systematic, rational strategy built around this fundamental human truth. He is not just trying to maximize returns, he is trying to minimize the probability of ever having to experience the devastating psychological and financial pain of a permanent, total loss of capital. A stock can fall 50%, and it is painful, but the investment still exists. You can still recover. But a company that goes bankrupt is a zero. The loss is permanent and absolute. It is the financial equivalent of death. By refusing to own companies that are susceptible to this fate, Buffett insulates himself and his shareholders from the single worst experience an investor can have. He has engineered his entire portfolio to avoid the left tail of the probability distribution, the realm of ruin. It's a strategy designed to protect his capital from financial disaster, which in turn protects his mind from the kind of panic and fear that leads to terrible decisions. For Buffett, the first rule of investing, "don't lose money," is not a folksy platitude. It is a psychologically astute directive to avoid the paralyzing pain of catastrophic loss, a pain that is amplified exponentially by the presence of debt. How can a retail investor apply this understanding of asymmetric risk to their own stock picking? The applied mental model is to think like a professional gambler and adopt a certainty of ruin framework. A professional blackjack player knows that even with a winning strategy, they can still experience a long string of bad luck. If they bet too much of their bankroll on any single hand, or even on a single session, they risk going broke. They will eventually hit a bad run of cards, and if their bets are too large, they will be wiped out. This is the mathematical certainty of ruin. Their primary goal is not to win the next hand, but to structure their bets in a way that allows them to stay at the table forever. A company with a high debt load is doing the opposite. It is betting its entire bankroll, its very existence, on the assumption that it will never have a long string of bad luck. It is betting that a recession won't happen, that a new competitor won't emerge, that its customers won't change their preferences. This is a bet that, over a long enough time horizon, is mathematically certain to fail. The blueprint for the investor is to become a ruin probability analyst. Before investing, you must systematically assess a company's chances of going to zero. This involves more than just looking at the current debt-to-equity ratio. It means digging into the company's financial statements to find the debt maturity schedule. How much debt is coming due next year? And the year after? Do they have enough cash on hand or predictable cash flow to meet those obligations without having to refinance? It means looking at the volatility of their earnings. Is this a stable, predictable business, or one whose profits swing wildly from year to year? A company with volatile earnings and a large debt payment coming due in 2 years is a ticking time bomb. The goal of this analysis is to only invest in businesses where the probability of ruin is as close to zero as humanly possible. You are actively selecting for companies that are structured to stay at the table forever. This focus on the downside, on the probability of ruin, is the stark opposite of the path of the 99%. The vast majority of investors focus exclusively on the upside. Their analysis, if they do any at all, consists of dreaming about what a company could become. They read glowing analyst reports that project earnings 5 years into the future. They get excited about a new product or a visionary CEO. They calculate their potential return if the stock goes from $20 to $100. This is a one-sided analysis, a form of financial daydreaming. They rarely, if ever, systematically analyze the downside. They don't download the company's annual report, the 10K, and scroll to the section on debt covenants. They don't build a simple model to see what happens to the company's solvency in a recession. They are playing a game of return maximization, completely oblivious to the far more important game of risk mitigation. They are like a pilot who meticulously plans the flight path to their destination but never bothers to check the fuel gauge or inspect the landing gear. They are so focused on where they want to go that they ignore the very things that could prevent them from ever arriving. This upside-only focus is a natural human tendency. It's more fun to dream about getting rich than it is to read the boring legal language of a bond indenture. But it is this failure to engage with the uncomfortable realities of financial risk that leaves their portfolios incredibly vulnerable to the kind of shocks that a more disciplined, debt-averse investor can sail through unharmed. The direct financial connection that makes this risk of ruin so tangible is the existence of debt covenants and callable debt. These are the tripwires buried in the fine print of a company's loan agreements. They are the contractual mechanisms that can turn a manageable business problem into a sudden corporate death sentence. A debt covenant is a set of rules imposed by the lender that the borrowing company must follow. For example, a covenant might state that the company's debt-to-EBITDA ratio cannot exceed 4x, or that its interest coverage ratio must remain above 3x. These are designed to protect the lender. Now imagine a manufacturing company that has a covenant to keep its debt-to-EBITDA ratio below 4x. The company is currently at 3.5x, so everything seems fine. Then a moderate recession hits, its sales drop, and its EBITDA falls by 25%. The amount of debt hasn't changed, but because the E in the ratio has shrunk, the ratio suddenly spikes to 4.7x. The company has just breached its covenant. At this point, the loan agreement gives the bank the right to declare a technical default. The bank can call the loan, demanding immediate repayment of the entire principal. Of course, the company doesn't have the cash to do this. It's forced to declare bankruptcy. Notice what happened here. The company was still profitable, just less so. In a world without covenants, it would have tightened its belt, weathered the storm, and recovered. But because of the covenant, the tripwire, a temporary business slump was instantly transformed into a permanent corporate failure. This is not a theoretical risk. It happens all the time. Understanding this mechanism is key. As an investor performing your due diligence, you must be aware that hidden within the company's financial filings are these hair-trigger clauses that can detonate the entire enterprise. It reinforces the core lesson. The true risk of debt is not the interest payments, but the loss of control, the fact that a bad year can put your fate in the hands of a nervous banker. This deeper understanding of risk leads to a fundamental shift in perspective. It's the difference between thinking like a temporary speculator and thinking like a permanent owner. This is the operator's mindset versus the speculator's gamble, and it changes everything about how you read a company's relationship with debt. One of the most illuminating case studies in Buffett's career, one that seems at first to contradict his anti-debt philosophy, is his massive acquisition of the Burlington Northern Santa Fe (BNSF) Railroad in 2009. This was a multi-billion-dollar all-in bet on America's future. Railroads are the quintessential capital-intensive business. They require enormous ongoing investments in track, locomotives, and terminals. And historically, they have always used a significant amount of debt to finance these assets. So why would the world's most debt-averse investor buy an entire railroad, debt and all? Because he was not looking at it as a stock, but as an enduring, critical piece of the American economic engine. He made this purchase in the dark days of late 2009, when the financial world was still reeling from the 2008 crisis. He got a fair price, but more importantly, he He understood the nature of the business and the nature of its debt. He saw that BNSF had a durable competitive advantage. You cannot build a competing railroad across the country. The rights-of-way are irreplaceable. It was part of a duopoly with Union Pacific in the western United States, giving it immense pricing power. This was a business that was going to be more valuable decades from now. With that operator's mindset, he then analyzed the debt. He saw that it was largely long-term fixed-rate debt. It wasn't the short-term variable-rate kind of debt that could blow up in a crisis. The railroad's earnings, while cyclical, were massive and predictable enough over the long term to comfortably service these obligations. He wasn't buying it with the intention of adding more leverage to juice the returns. He was buying it as a permanent holding for Berkshire Hathaway, an asset that would generate cash for the next century. He approached the debt not as a tool for financial engineering, but as a sensible, manageable way to finance long-lived critical assets. This is the crucial distinction. A speculator sees debt as a way to magnify their short-term returns on a stock. A true owner, an operator like Buffett, sees debt as a solemn obligation that must be structured in a way that can never, under any plausible scenario, threaten the existence of the enterprise. The BNSF acquisition wasn't a departure from his principles. It was the ultimate expression of them, demonstrating that the context and character of debt mattered just as much as the amount. This operator's mindset is a powerful antidote to a dangerous psychological flaw known as the Dunning-Kruger effect. This is a cognitive bias where people with low ability at a task overestimate their ability. In investing, it manifests as speculators who have a very superficial understanding of a business. They might know the ticker symbol, the recent stock performance, and the company's latest press release, but believe they have deep insight. This low level of knowledge leads to an unearned and dangerous level of confidence. They don't appreciate the immense operational complexities, the competitive threats, or the specific financial risks that an actual business owner would be intimately familiar with. They are, in a word, ignorant of their own ignorance. Buffett, by contrast, operates with a profound sense of intellectual humility. He stays within what he calls his circle of competence. His deep dive into the business of BNSF before buying it is a perfect example. He spent time understanding the industry's economics, its competitive landscape, and its regulatory environment. This deep knowledge gave him the ability to properly assess its debt load and make a rational decision. He possessed the deep, nuanced understanding of an owner. The speculator, suffering from the Dunning-Kruger effect, is blind to these nuances. They see that BNSF has debt, and a competitor, Union Pacific, has debt, and they assume it's all the same. They lack the detailed knowledge to distinguish between a responsibly managed, sustainable capital structure and a reckless, fragile one. The applied mental model that can instantly cure you of the Dunning-Kruger effect and force you into an operator's mindset is what I call the "would I own the whole thing" test. Before you buy a single share of any company, you must perform this powerful thought experiment. Ask yourself, if I had the necessary capital, would I buy this entire company, take it private tomorrow, and become personally and solely responsible for every single dollar of its debt? This question triggers a radical and immediate shift in your perspective. Suddenly, the daily squiggles of the stock price become irrelevant. The hot stock tip from your brother-in-law fades into the background. You are no longer thinking about what the market might do next week. You are thinking about the long-term survival and prosperity of the enterprise. You are forced to confront the debt not as an abstract number on a screen, but as a personal obligation. Would you be comfortable sleeping at night knowing you personally owed that $1 billion? Does the company's cash flow feel stable enough, predictable enough, for you to take on that responsibility? Would you be proud to tell your family that you now own this entire business? This mental exercise forces you to move beyond the superficial analysis of a speculator and adopt the rigorous, risk-averse, long-term perspective of a true owner. If you can't honestly say yes to this question, you have no business buying even a single share. It is the ultimate litmus test for separating a true investment from a reckless gamble. The failure to apply this test is why the 99% consistently make poor long-term decisions. The antithesis of the owner's mindset is the act of renting stocks. Most people don't think of themselves as part owners of a business. They see themselves as temporarily holding a ticker symbol that they hope someone else will buy from them at a higher price later. They are merely renting a small piece of paper, or more accurately, a digital entry in a brokerage account. This detached, transient mindset is the root cause of almost all bad investment behavior. Because they don't feel the psychological weight of ownership, they don't feel the terrifying weight of the company's debt. The company's liabilities are an abstract concept, something for the CEO and CFO to worry about. Their focus is entirely on the story, the hype, the quarterly earnings beat, and the analyst price targets. They are participating in a popularity contest, not engaging in the serious business of capital allocation. This renter mentality makes them susceptible to narratives and completely blind to balance sheet realities. They will happily rent a piece of a company with a dangerously high debt load because they plan to sell it before the bill comes due. But the market has a nasty habit of calling the bluff. When the credit markets freeze or a recession hits, the renters all rush for the exits at once, only to find there are no buyers. It is only then, when their investment has collapsed, that they learn the painful lesson that they were, in fact, owners all along, owners of a bankrupt enterprise. A specific red flag on the financial statements that an operator's mindset will immediately pick up on, but a renter's mindset will ignore, is the combination of high debt and a large amount of goodwill on the balance sheet. Goodwill is a peculiar accounting asset. It's created when one company acquires another for a price that is higher than the fair market value of its tangible assets like factories, inventory, and cash. This premium, this excess payment, is recorded on the acquirer's balance sheet as goodwill. In essence, it's a plug number representing the intangible things the acquirer bought, like brand recognition or customer relationships. A balance sheet that shows a large amount of debt alongside a large amount of goodwill is a massive warning sign. It is the financial footprint of a reckless, empire-building management team. It tells you that the company has borrowed a significant amount of money to go out and overpay for other companies. This is a doubly dangerous situation. First, the company is now burdened with the interest payments on the debt used to fund the acquisition. Second, the asset they bought, the goodwill, is flimsy. If the acquired company fails to perform as expected, the parent company is forced, by accounting rules, to write down or impair the goodwill. This means they publicly admit they overpaid. That write-down flows directly through the income statement as a massive loss, which in turn destroys shareholder equity. But here's the kicker. The debt they used to make the bad acquisition doesn't go away. It remains on the balance sheet. So the company is left with a smaller equity base and the same large pile of debt, making it instantly more fragile. This toxic combination of goodwill and debt is a clear signal that you are dealing with a management team focused on growth for growth's sake, not on the prudent, owner-oriented stewardship of capital. This brings us to our final and most practical pillar, the ultimate litmus test. This is where we translate all of this philosophy and all of these mental models into a concrete, actionable process of due diligence for the retail investor. It's about building a systematic checklist that allows you to quickly and efficiently analyze a company's balance sheet and separate the fortresses from the fragile. A wonderful story that highlights the positive outcome of this kind of diligence is Buffett's long and fruitful investment in the Washington Post Company. In the early 1970s, he began buying shares not just because he loved the newspaper business, but because he deeply admired its CEO, Katharine Graham. Graham was not a typical empire-building executive. She was a careful, intelligent, and shareholder-oriented steward of capital. She understood the business had a powerful competitive moat, and she refused to squander its profits on foolish, debt-fueled acquisitions. Instead, she ran the company with immense financial prudence. When the stock was cheap, she used the company's excess cash to buy back its own shares, increasing the ownership stake for the remaining shareholders like Buffett. She avoided debt. She focused on maximizing the long-term, per-share value of the business. Buffett recognized that Graham thought like an owner. She managed the company's balance sheet with the same care and conservatism that he would have. This wasn't a business he needed to fix or worry about. It was a business that already embodied his core principles. His investment in the Post became one of his most successful, not just financially but personally, as he developed a deep friendship and mentorship with Graham. The story is a powerful reminder that the goal of your due diligence is not just to find companies that you can justify buying. It's to find those rare businesses that are already being run with the kind of financial integrity and discipline you can trust for the long haul. The formal process of due diligence is not just about finding facts. It's a crucial tool for overcoming our own psychological flaws, particularly confirmation bias. This is our tendency to search for, interpret, and recall information in a way that confirms our pre-existing beliefs. If we like a company's products, or we admire its CEO, or we've heard good things about its stock, we will unconsciously look for evidence that supports our initial positive impression. We'll focus on the rising revenue and ignore the ballooning debt. We'll read the bullish analyst report and skip over the bearish one. A structured due diligence checklist acts as a circuit breaker for this bias. It forces you to confront the cold, hard, and often contradictory facts that reside on the financial statements. It doesn't matter how great you think the company's story is. The checklist forces you to ask the tough questions. How much debt do they have? Can they pay it? Are they burning cash? This systematic, unemotional process is designed to protect you from your own worst enemy, your own biased brain. So let's build that process. We'll call it the 5-minute balance sheet test. This is a quick, effective screening tool that any retail investor can use. Step 1. Find the company's balance sheet. You can get this for free on websites like Yahoo Finance, or directly from the company's investor relations website, where they post their quarterly and annual reports. Step 2. Locate two numbers. Total debt. Sometimes you have to add short-term debt and long-term debt together, and total shareholders' equity. Calculate the debt-to-equity ratio. As a general rule of thumb, is it over 1.0? That's worth a yellow flag. Is it over 2.0? That's a red flag that requires serious justification. Step 3. Find cash and cash equivalents. Now compare this to the company's short-term debt, also called current liabilities. A healthy company should have enough cash, or be generating enough cash, to comfortably cover all its obligations that are due within the next year. If its short-term debt is much larger than its cash on hand, it might face a liquidity crisis. Step 4. Flip over to the income statement. Find two numbers: operating income, also known as EBIT, and interest expense. Divide the operating income by the interest expense to calculate the interest coverage ratio. Is this number below 5x? Be cautious. Is it below 3x? This is a serious red flag, indicating a very thin margin of safety. Step 5. Go back to the balance sheet and look for the line item called goodwill. Compare the size of the goodwill to the size of total assets. Is it a huge percentage, say over 30%? This is your debt-fueled empire-building check. It suggests the company's assets are not hard, productive things like factories, but the ephemeral result of potentially overpriced acquisitions. This 5-step test is not a substitute for deep research, but it is an incredibly powerful first filter. In just 5 minutes, you can get a remarkably clear picture of a company's financial stability and avoid the most obvious landmines. This simple, empowering process is the direct opposite of what the 99% of investors do, which is to succumb to either analysis paralysis or what I call outsourced trust. Analysis paralysis is the state of being so overwhelmed and intimidated by financial statements that you do nothing. You know you should look at the numbers, but it seems too complicated, so you give up and just buy the fund your friend recommended. The other path, outsourced trust, is even more dangerous. This is when you blindly delegate your thinking to someone else. You buy a stock because a well-dressed analyst on television recommended it. or a popular financial YouTuber made a slick video about it. You are trusting that they have done the due diligence for you. This is a catastrophic mistake. These sources often focus on the exciting narrative, not the boring balance sheet. Their business model is to generate clicks and views, and stories about explosive growth are far more engaging than a sober analysis of debt covenants. By outsourcing your trust, you make your portfolio incredibly vulnerable. You are flying blind, completely unaware of the financial risks you are taking on. Taking just those 5 minutes to perform your own balance sheet test is the first step toward taking back control, toward becoming a self-reliant and truly intelligent investor. Finally, to tie all of this together, we must look at the third major financial statement, the cash flow statement. While the balance sheet is a snapshot in time, the cash flow statement is the movie. It tells the story of how cash is moving in and out of the business, and it is here that you can see a company's relationship with debt in action. Specifically, you want to look at the section called Cash Flow from Financing Activities. This section tells you exactly what the company is doing with its debt and equity. Is the company constantly issuing new debt year after year? You'll see a positive number next to issuance of debt. This can be a huge red flag. It might mean the company is not generating enough cash from its own operations to survive and needs to keep borrowing more and more just to stay afloat. This is a financial death spiral. Conversely, is the company consistently paying down its debt? You'll see a negative number next to repayment of debt. This is a wonderful sign of financial health and discipline. It shows that management is actively working to de-risk the balance sheet. You can also see other warning signs here. Is the company borrowing money in order to pay its dividend or to buy back its own stock? This is a form of financial engineering that is often unsustainable. A healthy company should fund its dividends and buybacks from its own internally generated cash flow, not from the bank. By learning to read this section of the cash flow statement, you can complete the picture. You can see not just how much debt a company has from the balance sheet and whether it can afford the interest from the income statement, but the direction in which the company is moving. Is it marching toward greater financial strength and stability, or is it sliding deeper into fragility and dependence? This holistic analysis of all three financial statements is the final step in mastering this crucial principle of wealth preservation. You have just completed an intensive course in financial resilience. You have journeyed through the core of Warren Buffett's most powerful principle for risk management. You no longer see debt as just a number on a page. You now see it for what it is, a measure of fragility, a claim on future prosperity, and the single most common cause of corporate extinction. You have acquired the Fortress Balance Sheet Filter, a powerful tool for portfolio protection that separates resilient businesses from the ticking time bombs hidden in the market. This knowledge fundamentally changes the way you will look at any investment for the rest of your life. But this filter, this intense focus on the balance sheet and the avoidance of risk, is just one pillar in the grand architecture of value investing. Buffett doesn't just look for safety. He looks for safety combined with extraordinary opportunity. He avoids the fragile, but how does he identify the truly magnificent? How does he determine the right price to pay for that safety and that quality? That is a different but deeply connected mental model. Avoiding the bad companies is the first step, but learning to identify the great ones at a fair price is how true generational wealth is built. The video that is appearing on your screen now is the next piece of that puzzle. It's the bridge from identifying what to avoid to identifying what to buy, Denty's law. It is the link that connects the fortress balance sheet to the concept of an economic moat, the key to unlocking true, sustainable wealth preservation and growth. It's the offensive strategy that complements the powerful defense you have just learned. You have taken the crucial first step by learning to protect your capital. Most people stop right there. They learn defense. But the true masters of long-term investing, the ones who build lasting fortunes, learn how to pair an impregnable defense with an intelligent, opportunistic offense. The choice is yours. Are you content with just surviving? Or are you ready to learn how to truly thrive? Complete your arsenal. Continue your journey. Click the video.